So, if I told you that one of the most uh, globally recognized, wildly profitable companies in the world is technically operating with negative equity, meaning its liabilities just completely swallow its assets, which, would make any personal financial advisor declare you utterly bankrupt, but its stock is just soaring. And then if I followed that up by telling you that if the United States government were to magically pay off the entirety of the national debt tomorrow, it would instantly trigger a total collapse of the global financial system because the US dollar would mathematically cease to exist. I mean, you probably think I was out of my mind, right?
Yeah, I mean, it sounds like absolute financial science fiction, but those two scenarios aren't theoretical anomalies at all. They're actually the deliberate engineered reality of how modern money functions.
Right. And that's exactly why we're doing this deep dive today. We are opening up a huge stack of research that basically attempts to map out this exact architecture. We're blending two incredibly complex frameworks here. On one side, we have CFA-level asset pricing mechanics, so, the deeply quantitative models that institutional investors use to value corporate equity and debt.
Right.
And then on the other side, we're layering in the classic macroeconomic frameworks of Frederick Mishkin, like the literal textbook mechanics of monetary policy and central banking. Our mission for you today is to decode the hidden plumbing of the financial system. We want to figure out where systemic liquidity actually hides and how the biggest market players just totally exploit those hiding spots to their advantage.
Because if you don't understand the medium that assets are priced in, you really can't possibly understand the prices themselves. I mean, by the time we reach the bottom of this stack of notes, you're going to see the stock market not as a collection of company valuations, but as a massive dynamic ecosystem of rate limiters, option value probabilities, and quite frankly, accounting illusions.
Yeah, accounting illusions is the perfect way to put it. I want to start with the concept of the water source, because most of us, we look at the stock market through the lens of charts, right? Moving averages, earnings reports, consumer sentiment. But today, we're tracking the actual pipes pumping money into those assets.
Exactly.
So before we can talk about how a multinational corporation manipulates capital, we have to define what money actually is in the modern era. My instinct is just to, look at my checking account on my phone and call that money. But the macroeconomic totes break this down into a very specific alphabet soup. So let's start at the absolute bedrock, the monetary base.
Right. So the monetary base, or MB, is the absolute origin point. Macroeconomists often refer to this as high-powered money. If you want to visualize it, MB is the literal balance sheet of the Federal Reserve. It consists of exactly two things: the physical currency in circulation and the reserve balances that commercial depository institutions, so your local and national banks, hold at the Federal Reserve.
Wait, I always hear the term bank reserves, but let's pause on that for a second to make sure I've got it. If I deposit $100 at my local bank, my bank doesn't just put that $100 bill in a vault with my name on it.
Right. Not at all.
They take a portion of it and they deposit it at their bank, which is the Federal Reserve.
That's exactly it. That is the core of fractional reserve banking. Commercial banks are required to hold, or they choose to hold for safety, a fraction of their customers' deposits as reserves at the central bank. So the monetary base is the seed from which all other liquidity grows. It's really the only tier of money that the central bank can directly create, control, or destroy. Every other metric we look at is just a derivative of this base.
Okay, so moving up from the base, we hit M0. And the notes describe M0 as physical currency, which, in a world where I pay for groceries by tapping my phone and my paycheck is a direct deposit, physical cash feels almost archaic. I mean, I honestly couldn't tell you the last time I broke a physical $20 bill. Why do economists still track M0 so closely if it's practically obsolete for our daily commerce?
Well, it's a mistake to think of M0 merely as a transaction medium for, buying a cup of coffee. M0 serves two critical structural roles in the global economy. First off, it is the ultimate bearer instrument. A digital dollar in your checking account is actually a liability of your commercial bank. Right. Meaning it relies on the bank remaining solvent. But a physical $100 bill, right, that is a direct claim on the central bank itself. It carries zero commercial counterparty risk.
Oh, that makes sense. If my bank goes under, my app might freeze and lock me out, but the paper bill in my pocket still spins.
Exactly. Which leads to its second function. M0 is basically a systemic panic thermometer. During periods of severe financial distress, think of the immediate aftermath of the Lehman Brothers collapse in 2008, or the onset of major geopolitical conflicts. Trust in commercial institutions just evaporate.
People want the physical cash.
Right, they rush to ATMs to convert their digital bank liabilities into physical central bank liabilities. So if you are analyzing monetary data and you see a sudden, sharp spike in M0 demand while broader credit growth is stagnant, you aren't looking at an economic boom. You are looking at sheer fear.
Oh, right.
And furthermore, it's estimated that half to two-thirds of all physical U.S. currency actually circulates outside the United States. It operates as a vital safe haven asset in emerging markets with unstable domestic currencies.
So M0 is the panic gauge and the global mattress stuffer.
Got it. Then we step into M1 and M2, which seem much more relevant to domestic economic growth. The traditional definition of M1 is narrow money, right? It's the M0 cash plus our standard friction-free checking accounts, like the money I can use to pay my mortgage right this second. Yes, M1 represents immediate liquid purchasing power. It is money that requires no time delay or penalty to deploy. M2, on the other hand, is broad money. It encapsulates all of M1, but it adds what economists call near money.
Near money being things like my traditional savings account or a small certificate of deposit or maybe a retail money market fund.
Correct. It's capital that is highly liquid, but there is a slight friction or an intended time horizon attached to it. You don't generally write a check directly out of a CB, you know? So M2 is the definitive gauge for macroeconomic credit expansion. It tells us the total size of the potential purchasing power pool in the economy.
Okay, I'm trying to picture the mechanics connecting the Federal Reserve's monetary base, the seed, to this massive M2 pool of purchasing power. The notes highlight the money multiplier formula, which is simply capital M equals a lowercase m multiplied by the monetary base. The lowercase m is the multiplier.
Right. And the transition from the monetary base to M2 is not a direct one-to-one conversion. The Federal Reserve plants the MB seed by injecting reserves into the banking system. The commercial banks act as the soil. They take those reserves, retain a fraction, and lend the rest out to businesses and consumers.
And then those loans become deposits somewhere else.
Exactly. Those loans are deposited back into other banks, which hold a fraction and lend the rest out again. This iterative process of lending and depositing is what multiplies the initial base money into a much larger supply of M2 broad money.
But see, that implies a mechanical certainty that I just don't think exists in the real world. What happens if the soil turns toxic? Say we enter a massive recession. The Federal Reserve aggressively expands the monetary base. They plant millions of new seeds, but the commercial banks look at the economy, decide the default risk is just way too high, and simply refuse to lend. They just sit on the reserves.
You've perfectly identified the behavioral constraint of the money multiplier. It is heavily dependent on the risk appetite of the commercial banking sector and the borrowing demand of the public. If banks hoard excess reserves to repair their own balance sheets, or if consumers focus entirely on paying down existing debt rather than taking out new loans, the multiplier shrinks.
Which means the Federal Reserve can print high-powered money all day long, but if the commercial banks don't facilitate the multiplication process, broad money doesn't actually grow, and you don't get the inflation or economic stimulation the Fed was hoping for.
Right. And we saw this exact dynamic play out in the years following the 2008 financial crisis. The Federal Reserve engaged in massive quantitative easing, expanding the monetary base dramatically, and commentators everywhere predicted immediate hyperinflation.
Yeah, I remember that.
But the inflation didn't materialize for years because the commercial banking system was severely damaged. They hoarded the newly created reserves, the multiplier collapsed, the water was pumped into the reservoir, but the valves leading to the broader economy were tightly shut.
Man, okay. So if I'm an investor trying to read the tea leaves, the notes point to a specific metric called the M1-M2 scissors gap. If I'm tracking the growth rate of these two tiers, what exactly am I looking for?
You are looking for the behavioral shift between active spending and defensive saving. If M1 is growing at a faster rate than M2, creating a positive scissors gap, it indicates that businesses and consumers are migrating capital out of term deposits and savings and moving it into active checking accounts.
Getting ready to spend it.
Exactly. They are positioning themselves to deploy capital, whether for consumption or investment. This is generally a very bullish signal for risk assets and economic velocity.
And a negative gap would mean capital is retreating into the safety of yielding term deposits. People are battening down the hatches. But as I'm looking at these historical charts in our notes, there is a massive glaring anomaly. If I pull up a chart of the M1 money supply over the last 40 years, it follows a relatively smooth upward curve. And then in May of 2020, the line goes completely vertical.
Oh, yes, that spike.
It looks like the Federal Reserve quadrupled the amount of spending money in the economy overnight. I remember seeing this on financial blogs, and people were absolutely terrified that the U.S. dollar was about to become monopoly money. But the notes suggest this spike was largely a statistical illusion.
It was one of the most misunderstood macroeconomic data points of the decade, honestly. The Federal Reserve did engage in aggressive monetary expansion in early 2020 to combat the pandemic lockdowns, obviously, but that vertical spike in M1 was primarily driven by a sudden, drastic change in banking regulations, specifically regarding something called Regulation D.
I know banks are heavily regulated, but how does one single rule change visually break the money supply chart?
To understand the change, we have to look at why Regulation D existed in the first place. Historically, the Federal Reserve mandated that consumers were limited to a maximum of 6 convenient withdrawals or transfers per month from a standard savings account.
Oh, I remember that. If you transferred from savings to checking too many times, you got hit with a fee.
Right. And this friction was intentional. It allowed commercial banks to treat savings deposits as a more stable funding source for their long-term lending operations compared to a checking account, which could be drained to zero on any given day.
Right. The banks need to know the money's going to stick around for a little while if they're going to lend it out for a 30-year mortgage.
Because of that mandated friction, the 6 withdrawal limit, the Federal Reserve statistically classified savings accounts as part of M2, but they actively excluded them from M1. They did not consider savings to be immediate, friction-free purchasing power.
But then the pandemic hits. The economy shuts down, people are losing their jobs, and they need immediate access to whatever cash they have stashed away.
Exactly. So to alleviate financial stress and provide consumers with maximum flexibility, the Federal Reserve permanently removed the 6 withdrawal limit on savings accounts in the spring of 2020.
Oh, I see the accounting math happening here. If a savings account no longer has withdrawal limits, it functions mechanically exactly the same as a checking account.
And therefore, it had to be reclassified. Overnight, the Federal Reserve took trillions of dollars of existing savings deposits out of the M2 exclusive category and dumped them directly into the M1 category.
Wow.
The money wasn't newly created, it was simply moved from one statistical bucket to another. But because algorithms and amateur analysts were simply tracking the top-line M1 growth rate, it triggered widespread panic about hyperinflationary money printing.
So the practical takeaway for anyone doing macroeconomic analysis today is that M1 data is fundamentally contaminated. If you want a clear picture of whether systemic liquidity is actually expanding or contracting, you have to look at the year-over-year growth of M2, because M2 encompasses both checking and savings, rendering the internal reclassification totally moot.
That is the analytical reality. You must filter out the regulatory noise.
Okay, that makes sense for traditional banking. But let me throw a wrench into this framework, because my own personal financial behavior doesn't fit neatly into checking or savings anymore. With interest rates hovering around, 5% over the last couple of years, leaving cash in a bank account that pays 0.01% feels like financial malpractice.
Yeah, absolutely.
So, like a lot of people, I sweep my idle cash into my brokerage account and buy a short-term Treasury ETF, something like SGOV. It pays a yield practically identical to the federal funds rate. It is backed by the U.S. government, and if I need the cash, I can sell it during market hours and have the funds available immediately. In my mental accounting, that SGOV position is my cash reserve. Where does my Treasury ETF fit into the M2 data?
This is where we transition from the traditional banking system into the realm of shadow banking. To answer your question directly, your SGOV ETF is not counted in M1, and it is not counted in M2.
Wait, my cash just vanishes from the monetary statistics.
From the perspective of the Federal Reserve's monetary aggregates, yes. When you transfer funds from your commercial bank savings account, which is part of M2, into your brokerage account, and you execute a trade to purchase SGOV, you are engaging in a process called disintermediation.
Meaning I am cutting out the middleman. The commercial bank is the middleman.
Precisely. You are bypassing the traditional banking sector entirely. Instead of depositing your money in a bank, which the bank then uses to buy treasuries or make loans, you are effectively lending your capital directly to the United States Treasury by holding their short-term debt through the ETF structure. The moment that cash is exchanged for the Treasury security, it ceases to be classified as money. It becomes a security asset.
So when millions of retail investors and corporate treasurers simultaneously wake up and realize they can get a 5% yield in short-term treasuries instead of 0% of the commercial bank, a massive exodus of capital occurs.
And that exodus causes the M2 money supply to physically shrink. Over the last 2 years, financial media has run countless headlines blaring that M2 is contracting at the fastest rate since the Great Depression, predicting an imminent catastrophic market crash because the liquidity was supposedly evaporating.
But the liquidity wasn't evaporating at all. It was just changing outfits. It was migrating out of the highly regulated, mathematically tracked M2 banking system and hiding in the shadow money system of short-term government debt.
You've hit on the core concept of the modern liquidity spectrum. We can no longer rely on rigid mid-20th century definitions of money. Short-term treasury bills function as pristine collateral in the financial plumbing. They hold immense immediate purchasing power. They can be repoed or liquidated instantly. The overall systemic liquidity remains robust, even as the traditional M2 metric flashes warning signs, because the purchasing power is parked in these shadow money assets waiting on the sidelines.
Let's follow that dollar even further down the spectrum. Let's say the stock market takes a dip, and I decide it's time to deploy that sideline cash. I sell my SDOV ETF. The cash hits my brokerage sweep account. What happens to the M2 metrics in that split second?
The proceeds of your ETF sale are typically swept into a retail money market fund managed by your brokerage. Because retail money market funds are officially classified as M2, your capital briefly flashes back onto the Federal Reserve's radar. M2 expands slightly.
But I don't leave it there. I immediately buy 10 shares of NVIDIA. The trade executes. Where's the money now?
The moment the trade settles, you no longer possess money in any macroeconomically defined sense. You own an equity asset. The purchasing power has been entirely transferred. The cash you used to buy the shares is routed through the clearinghouses and deposited into the account of the seller.
So the total amount of money in the system doesn't change when I buy a stock. It just changes hands.
Exactly. The seller now holds the M2 cash. If they leave it in their account, M2 remains stable. If they use it to buy a car, it circulates through the real economy. But for you, the investor, your capital has exited the monetary aggregates. It is now subject to the volatile, subjective valuation of the equity markets.
Man, that shadow banking migration is fascinating at the retail level. I mean, I'm moving a few $1,000s to chase yield. But the notes transition here to examine how the absolute titans of the global economy manage their liquidity. It's one thing to figure out where to park an emergency fund. It's an entirely different universe when you have $100 billion of free cash flow on your balance sheet. The contrast presented here between Google, Alphabet, and McDonald's is staggering. Let's start with Google. They essentially run a toll booth on the internet. They print cash.
They do. Google is the quintessential modern net lender corporation. Their underlying business model, search algorithms, digital advertising, software services, is built on a philosophy of bits over atoms. While they do have significant data center infrastructure costs, their capital expenditures are incredibly low relative to the massive high-margin revenue they generate. They do not need to construct a new billion-dollar manufacturing plant every time they add 1 million new users. Consequently, their operations generate an absolute geyser of free cash flow, far exceeding what they could possibly reinvest into their core business.
So they have an embarrassment of riches. Tens of billions, sometimes hundreds of billions of dollars sitting around. They obviously aren't walking down to the local Chase branch and opening a business checking account. I mean, the FDIC insurance limit is only $250,000.
Right. For a corporation holding $100 billion, leaving it as an uninsured deposit in a commercial bank is an unacceptable, potentially fatal counterparty risk. If that commercial bank were to face a run or fail, even a massive systemically important bank, Google's working capital would be frozen in receivership. They cannot expose their treasury to that risk.
So how do they safely store $100 billion while still earning a return?
They bypass the traditional commercial banking sector entirely, just as you did with your Treasury ETF, but on an industrial scale. Google's corporate treasury department operates effectively as a sophisticated asset management firm. They deploy their excess capital into institutional money market funds, direct purchases of sovereign treasury debt, and crucially, the commercial paper market.
Let's unpack commercial paper, because this seems to be the hidden circulatory system of corporate finance. What exactly is it?
Commercial paper is a short-term, unsecured promissory note issued by a corporation. It is essentially an IOU. When a massive, highly rated company needs working capital to cover payroll, build inventory, or manage external cash flow variations, they don't go to a bank for a traditional loan. The bank would charge a premium, require covenants, and the process is slow. Instead, the company issues commercial paper directly to the open market, typically with maturities ranging from just a few days up to 9 months.
And it's unsecured, meaning there's no collateral backing it.
Exactly. It is backed solely by the pristine credit rating and cash flow reputation of the issuing company. Only the highest-tier blue-chip corporations can successfully issue unsecured commercial paper at favorable rates.
So bringing this back to Google, Google takes its billions in advertising profits, and instead of depositing it in a bank, they buy the commercial paper issued by other massive corporations.
Correct. Google is taking its excess M1 cash flow and acting as a shadow bank. They are functioning as a direct lender in the wholesale funding markets. They earn a higher yield than they would on government debt, and the borrowing corporations secure cheap, flexible financing without ever interacting with a traditional commercial loan officer. It is a closed-loop system of mega-corporate liquidity.
Okay, that paints a really clear picture of the tech giant model. Hoard cash, become a shadow lender, but then we flip the page to McDonald's. And this is where the notes completely shatter conventional financial logic. McDonald's is arguably one of the most stable, recognizable businesses on the planet. But if you look at their balance sheet, they don't hold a massive cash hoard. In fact, if you look at their total equity, the number is often negative.
McDonald's represents the polar opposite capital strategy. They are a structural net borrower, and their negative equity is not a sign of financial distress. It is the hallmark of a highly engineered, aggressively optimized corporate structure.
Let's slow down here because my brain is really struggling to reconcile this. In personal finance, equity is your assets minus your liabilities. If my house is worth $300,000, but my mortgage is $400,000, my equity is negative $100,000. I am underwater. I am technically insolvent. How can a multinational behemoth like McDonald's operate, let alone thrive and pay dividends, with negative equity?
Well, the key to understanding the McDonald's model is recognizing the sheer predictability of their business. While consumers view McDonald's as a fast food restaurant, financially, they operate primarily as a massive real estate and franchising conglomerate. They own the prime real estate locations, they lease them to franchisees, and they collect a percentage of the gross sales as royalties. This structure generates a river of cash flow that is incredibly stable, almost annuity-like in its predictability, regardless of minor macroeconomic fluctuations.
Yeah, I mean, people are always going to buy cheap burgers, and the franchisees always have to pay rent.
Precisely. Because their future cash flows are so incredibly certain, McDonald's management realizes they do not need to maintain a massive defensive cash buffer like a volatile technology company might. Holding excess cash is viewed as highly inefficient. So they utilize their impeccable credit rating to go to the bond market and borrow billions of dollars in long-term debt at very attractive interest rates.
Okay, they borrow billions. But if they aren't using that debt to build thousands of new restaurants, what are they doing with the money?
They use the borrowed debt, combined with their operational free cash flow, to aggressively and systematically buy back their own stock on the open market.
They're borrowing money to buy their own stock. This feels like a snake eating its own tail. How does buying back stock drive equity below zero?
It comes down to corporate accounting rules. When a company repurchases its own shares, those shares don't just vanish. They are recorded on the balance sheet in a specific line item called treasury stock. Crucially, treasury stock is a contra-equity account. It physically subtracts from the company's total equity.
Because they are returning the capital to the shareholders. The company is actively shrinking its own capital base.
Exactly. McDonald's has pursued this strategy so aggressively over the last decade, repurchasing shares at market valuations that far exceed the original book value of the stock, that the negative drag of the Treasury's stock line item has grown massive enough to completely overwhelm their retained earnings. It drags the aggregate total equity figure into negative territory.
Wait, if equity is negative and they are intentionally replacing it with debt, isn't there a physical limit to that? They can't just have infinite debt, right? There has to be a ceiling where bondholders look at the balance sheet and say, okay, this is too much leverage, we won't lend you anymore.
There is a limit, and it is governed by interest coverage ratios and credit rating agencies. Bondholders don't care about the accounting artifact of negative equity. They care about the company's ability to service the debt payments out of operating cash flow. As long as McDonald's operating profits remain robust enough to easily cover the interest expense, the bond market will happily continue to lend to them.
But why go to such extreme lengths? Why play this aggressive financial engineering game? Why not just hold a moderate amount of cash, pay off the debt, and keep equity comfortably positive? It seems like an unnecessary tightrope walk.
They do it because of a core corporate finance principle known as WACC optimization. WACC stands for the weighted average cost of capital. The fundamental job of a corporate executive team is to fund the company's operations using the cheapest possible mix of capital to maximize the value delivered to the owners.
And debt is cheaper than equity.
Almost always. Equity investors take on the ultimate downside risk. If the company goes bankrupt, they are wiped out completely. Therefore, they demand a high rate of return, whether through growth or dividends, to compensate for that risk. Debt investors, conversely, have a senior contractual claim on the company's assets and cash flows. Because their risk is substantially lower, especially with a stable company like McDonald's, they are willing to accept a much lower fixed interest rate.
So replacing expensive equity capital with cheaper debt capital lowers the overall blended cost of running the business.
Yes, but there is an even more powerful mechanism at play: the corporate tax shield. In the United States, and in most jurisdictions, the interest payments a company makes on its debt are tax-deductible expenses. They reduce the company's taxable income. Dividends paid to equity holders, however, are paid out of after-tax profits.
Ah, so the tax code literally subsidizes the use of debt.
Dramatically so. Imagine McDonald's calculates that their cost of equity is 10% and their nominal cost of issuing a new bond is 5%. But if their effective corporate tax rate is around 20%, the actual after-tax cost of that debt drops to roughly 4%. By systematically retiring 10% equity and replacing it with 4% debt, they drastically lower their weighted average cost of capital, which mathematically increases the intrinsic valuation of the firm. They are running the balance sheet as close to the theoretical edge of maximum efficiency as possible, relying entirely on the fortress-like certainty of their daily cash flows to service the leverage.
Wow, this completely breaks how I evaluate stocks. If I open a standard brokerage app and look at the fundamental metrics for McDonald's, the traditional ratios are basically useless. Price-to-book ratio divides the stock price by the equity. If equity is negative, the PB ratio is a negative, it means nothing. Return on equity ROE divides net income by equity. A massive positive profit divided by negative equity gives you a negative return percentage. The stock screener makes it look like a distressed asset.
This is exactly why algorithmic or superficial fundamental analysis can be dangerous. Traditional metrics were built for industrial companies with heavy physical assets and positive equity cushions. To evaluate a hyper-optimized, franchise-driven structure like McDonald's, analysts have to look past the capital structure distortions. They use DuPont analysis to decompose the operational efficiency, but primarily they rely on ROIC, return on invested capital.
How does ROIC fix the negative equity problem?
ROIC ignores the distinction between debt and equity. It looks at the total net operating profit the company generates after taxes and divides it by the total amount of capital invested in the business, regardless of where that capital came from. It measures the pure operational engine of the business. For McDonald's, the ROIC is consistently phenomenal, which proves the underlying business is incredibly healthy, even if the engineered balance sheet looks broken to an amateur observer.
So McDonald's strategy is undeniably brilliant during normal economic conditions. You borrow cheap debt, you shrink the share count, earnings per share skyrocket, and the stock price goes up. But it relies entirely on the assumption that the credit markets will always be open. What happens when the music stops? What happens when a black swan event hits, panic sets in, and the banks simply refuse to roll over any corporate debt? Because if you are highly leveraged and the credit window slams shut, that mathematically optimized balance sheet suddenly looks like a death trap.
That is the ultimate stress test for any highly leveraged model. And we don't have to guess how it plays out because the 2008 financial crisis provides a perfect historical laboratory. The credit markets froze entirely. To understand why McDonald's survived, we have to look closely at the corporate titans that were decimated by that exact scenario. Let's contrast McDonald's with the pre-2008 iteration of General Electric and the ultimate casualty, Lehman Brothers.
Okay, let's start with General Electric. Prior to 2008, GE wasn't just making light bulbs and washing machines. They were viewed as the pinnacle of American corporate management. But they nearly went bankrupt. What was their fatal flaw?
Pre-2008, General Electric had essentially built a massive, unregulated shadow bank inside their industrial conglomerate, known as GE Capital. GE Capital provided financing for everything from consumer credit cards to commercial real estate to commercial aviation. And in funding those operations, they committed the cardinal, unforgivable sin of banking: maturity mismatch.
Break that down for me. What does a maturity mismatch look like in practice?
It is the structural misalignment between the timeline of your assets and the timeline of your liabilities. Imagine GE Capital underwrites a loan to a major airline to purchase a fleet of jet engines. The airline agrees to pay GE back over 20 years. That loan is a long-term, highly illiquid asset for GE.
Right, but GE has to get the cash to buy the jet engines in the first place.
Exactly. And instead of funding that 20-year asset by issuing 20-year corporate bonds, which would be a matched maturity but would carry a higher interest rate, GE Capital funded it by issuing massive amounts of 30-day commercial paper. They borrowed money at rock bottom, short-term rates to fund long-term assets, capturing a massive profit spread in the middle.
Oh, wow. So they have a 20-year asset, but their debt comes due every single month, meaning every 30 days they have to find new investors to buy new commercial paper just to pay off the old investors who are cashing out.
It is called rolling over the debt. And as long as the credit markets are calm and liquidity is flowing, it works seamlessly. It feels like free money. But when the subprime mortgage crisis triggered a global panic in the fall of 2008, trust evaporated overnight. Institutional investors, money market funds, and other corporations completely stopped buying commercial paper. They hoarded cash instead. GE suddenly found themselves holding 20-year assets, but they were entirely locked out of the short-term funding markets.
They couldn't roll it over.
No, they couldn't roll over the debt. They needed billions of dollars immediately to pay off maturing paper and to make basic operational payroll, and the money simply wasn't there. They faced a catastrophic existential liquidity freeze.
And Lehman Brothers, they suffered the same fate, but they didn't survive it.
Lehman Brothers suffered from a fatal combination. They employed the same extreme maturity mismatch, relying heavily on overnight repo markets to fund their operations. They were borrowing money every single day to survive until the next morning. But unlike GE, whose underlying assets were tangible things like jet engines and medical equipment, Lehman's balance sheet was stuffed with toxic, rapidly defaulting subprime mortgage-backed securities.
Ouch.
Yeah. They faced a liquidity crisis because they couldn't roll over their debt, but they also faced an insolvency crisis because their actual assets were becoming worthless.
Okay, so GE and Lehman stared into the abyss because they relied on short-term debt and the market froze. But wait. We just spent the last 10 minutes establishing that McDonald's is also heavily leveraged.
Yeah.
They also rely on debt. Why did McDonald's crash and burn alongside GE when the commercial paper market seized up?
It comes down to the quality, certainty, and nature of the underlying cash flows. In macroeconomic theory, there is a behavioral concept known as the lipstick effect.
Oh, the idea that in a recession, people can't afford luxury items, so they treat themselves to small, inexpensive indulgences.
Exactly. When a severe recession hits, consumers cancel vacations and delay buying new cars, but they still buy a tube of lipstick, or they take the family to the McDonald's drive-thru instead of a sit-down restaurant. In economic terms, McDonald's offers an inferior good, meaning that demand for their product actually remains stable or even increases as aggregate consumer income falls.
Their cash flow is practically recession-proof.
And the institutional credit markets knew this. When the panic hit, investors fled from anything tied to housing, banking, or complex financial engineering. But those investors still needed a place to park their short-term cash where they knew they would get paid back. McDonald's commercial paper became an unexpected safe haven. The credit markets looked at the daily global burger sales and recognized that McDonald's had the tangible incoming cash flow to honor their short-term debts, regardless of what the broader economy was doing.
That's wild. So while GE was begging for liquidity and Lehman was collapsing, institutional money was actively seeking out McDonald's debt because selling burgers was deemed a safer bet than mortgage derivatives.
Yes. However, it's crucial to understand that the systemic freeze was so profound that even safe haven status wasn't enough to prevent a total economic shutdown. The commercial paper market was so paralyzed that the Federal Reserve had to execute an unprecedented intervention.
Yeah, the notes detail the creation of the CPFF, the Commercial Paper Funding Facility. How did this mechanism actually work?
The central bank realized that traditional commercial banks were too terrified to perform their intermediary function. The soil of the money multiplier was completely frozen. So the Federal Reserve invoked emergency powers to bypass the banking sector entirely and act as the direct lender of last resort to the real economy. Through the CPFF, the Federal Reserve stood ready to purchase Tier 1 commercial paper directly from major corporations.
Tier 1 meaning the absolute highest credit rating.
Correct. Mega corporations with impeccable short-term credit profiles, companies like McDonald's, Coca-Cola, and yes, even GE, because their underlying industrial assets were still fundamentally sound, were able to issue commercial paper and sell it directly to the Federal Reserve. The central bank provided the immediate liquidity required to ensure these industrial giants could make payroll, pay suppliers, and keep the real economy functioning.
But they did not extend this lifeline to Lehman Brothers.
They could not. The facility was strictly designed for highly rated performing assets. Lehman's collateral was toxic, and their credit rating was collapsing. The mechanics of the facility required sound collateral to protect the central bank's balance sheet.
I know this intervention is heavily debated. The mechanics are clear, but the fallout is complex. And obviously, we're not taking sides here.
Right. It remains one of the most fiercely debated policy actions in modern economic history. Our goal here is just to neutrally observe the mechanics, but we must acknowledge the two prevailing viewpoints. One side argues the intervention created massive moral hazard, the idea that if you bail out reckless corporate leverage, you socialize the losses while privatizing the gains, encouraging even riskier behavior in the future because executives believe a central bank safety net will always exist.
And the other side.
The opposing viewpoint argues the intervention was an absolute systemic necessity that allowing the commercial paper market to freeze would have caused thousands of fundamentally healthy companies to miss payroll simultaneously, transforming a Wall Street banking crisis into an immediate catastrophic depression in the real economy. Both perspectives are analyzing the exact same mechanical deployment of liquidity.
Regardless of the debate, the mechanical reality is that McDonald's survived because their tangible cash flow served as the ultimate pristine collateral. Okay, I follow the logic of a blue-chip powerhouse surviving a crisis. But this shadow banking framework brings us to a phenomenon in the stock market that has always completely baffled me.
Okay.
If McDonald's is the rational safe haven, how do we explain the absolutely bizarre behavior where a fundamentally failing company, a business with declining revenue, mounting losses, hovering on the absolute edge of bankruptcy, suddenly sees its stock price skyrocket by 300% the moment the Federal Reserve merely hints at cutting interest rates? Why do distressed garbage stocks react more violently to monetary policy than solid blue chips?
To crack that puzzle, we have to leave traditional fundamental analysis behind entirely. We have to look at equity through the lens of advanced CFA asset pricing, specifically applying the Merton model. We must stop thinking of a share of stock as simply a fractional ownership claim on a business's cash flows and start viewing it as a financial derivative.
A derivative, like an options contract.
Exactly like an options contract. The Merton model proposes a brilliant, counterintuitive framework. The equity of a leveraged company is mathematically equivalent to a call option on the total assets of the firm. And the strike price of that call option is the face value of the company's debt.
Okay, we need to build a hypothetical model here step by step, because applying options theory to a whole company is a heavy lift for me to wrap my head around. Let's imagine a basic company.
Let's create Company A. Company A has a single massive loan of $100 million. That debt is due in exactly 1 year. Now, let's say that right now, the total market value of all of Company A's factories, inventory, and intellectual property, its total assets, is $150 million.
The assets are 150, debt is 100.
Fast forward 1 year to the maturity date. The debt is due. The equity holders, the owners of the stock, have the right to essentially buy the company from the debt holders by paying off the $100 million loan. Because the assets are worth $150 million, they gladly pay off the $100 million, and they capture the remaining $50 million in value. In options terminology, this call option is in the money. The equity has robust value.
That makes perfect sense for a healthy company. But let's look at Company B, the failing garbage stock. They also have $100 million in debt due in 1 year, but their business is collapsing. Their total assets are currently only worth $80 million.
Under standard accounting rules, Company B is technically insolvent. Their liabilities exceed their assets. If the debt were due today, the equity holders would walk away. They wouldn't pay $100 million to acquire assets worth only $80 million. The debt holders would seize the company and the stock would be wiped out. The call option expires worthless.
So if the assets are worth less than the debt, why is the stock currently trading at $5 a share on the open market instead of $0? Are retail investors just blindly gambling?
They are gambling, but it is a mathematically quantifiable gamble. The key is that the debt isn't due today. It's due in 1 year. In options pricing, there is a concept called time value. As long as the company hasn't officially declared bankruptcy, there is a statistical non-zero probability that a miracle occurs before the debt matures. Maybe a massive competitor decides to buy them out. Maybe they pivot and invent a viral product. Maybe a broader economic boom inflates the value of their assets above the $100 million strike price.
So the investors buying the stock aren't valuing the company based on its current failing business model. They're pricing the stock based entirely on the probability of a future miracle.
Yes, they are buying a lottery ticket, a deep, out-of-the-money call option. The stock price represents pure time value and volatility. Now, let's bring the Federal Reserve into this scenario. Imagine the macroeconomic data softens and the Federal Reserve suddenly announces an aggressive cycle of interest rate cuts. How does this monetary policy shift affect our two companies? Let's start with Company A, our healthy blue chip.
Well, for Company A, lower interest rates are good news. When they eventually need to refinance their debt, it will be cheaper. Their discounted cash flow models look a little better. Their stock goes up a reasonable amount, maybe 5 or 10%.
Correct. Because Company A is deeply in the money, the value of its equity moves somewhat linearly with the value of its assets. In options parlance, it's delta. The sensitivity to the underlying asset is very close to 1. It behaves like a normal stock. But now apply that rate cut to Company B, our failing garbage stock. A rate cut isn't just a minor improvement to their margins, it is a fundamental lifeline.
Because the lower rates change the probability of their survival.
Drastically. A significant Fed rate cut signals that systemic liquidity is increasing, and credit is becoming cheaper and more accessible. Suddenly, the probability that Company B can convince a shadow bank or a hedge fund to refinance that $100 million loan instead of forcing a default improves significantly. The probability of survival might jump from a bleak 0.1% to a slightly less bleak 2%.
Wait, a jump from 0.1 to 2% sounds tiny in absolute terms, but that's a 20-fold relative increase in the chance of survival.
And that relative explosion in probability triggers the complex dynamics of options pricing, specifically the Greeks, Delta, and Vega. Because this option is deep out of the money, a small absolute increase in the underlying asset value, combined with a surge in market volatility, which is measured by Vega, causes a massive nonlinear explosion in the price of the option. The stock doesn't go up by 5%. The mathematical repricing of that survival probability forces the stock up by 300, 400, or 500% in a matter of days.
Wow, this perfectly explains the meme stock phenomenon of 2020 and 2021. The Federal Reserve slashed rates to zero and flooded the system with liquidity. Companies that traditional analysts had completely left for dead, failing brick-and-mortar retailers, struggling movie theater chains, suddenly had their survival options repriced astronomically higher by the market. The retail frenzy provided the volatility of the Vega that poured gasoline on the fire.
Precisely. The stock is not the company. The stock is merely a derivative instrument tracking the probability that the company won't default before its debt matures. When central banks alter the cost of debt, they aggressively manipulate those probabilities, creating wild distortions in the equity markets.
Okay, this brings us to the absolute core of the plumbing. We've talked extensively about how the Federal Reserve expands the monetary base, injects liquidity, and manipulates interest rates to save corporations or inflate asset prices. But mechanically, how do they actually pull this off? How does a central bank manifest billions of dollars out of thin air? I want to pull back the curtain on the actual keystroke-by-keystroke accounting of quantitative easing, or QE.
To truly understand quantitative easing, you have to abandon the cartoonish mental image of a printing press churning out pallets of green paper. Modern fiat money creation is entirely digital. It is pure double-entry accounting magic. It relies entirely on the fundamental equation of a balance sheet. Assets must equal liabilities.
Walk me through a transaction. Let's say the economy is stalling, and the Federal Reserve decides it needs to inject $1 billion of new liquidity into the system. What happens on the trading desk?
The Federal Reserve's trading desk in New York will contact a major systemically important commercial bank. Let's use JP Morgan as our example. The Fed offers to buy $1 billion worth of existing U.S. Treasury bonds that JP Morgan currently holds in its investment portfolio. JP Morgan agrees to the price and digitally transfers ownership of those Treasury bonds to the Federal Reserve.
Okay, so the Fed takes possession of the bonds. On the Fed's balance sheet, under the assets column, they add $1 billion in Treasury securities. But how do they pay JP Morgan for those bonds? Where does the cash come from? Does the Fed have a giant checking account they draw from?
No, the money does not exist prior to the transaction. To pay for the bonds, the Federal Reserve simply logs into the digital ledger that tracks JP Morgan's reserve account, which, remember, is held at the Federal Reserve, and they execute a few keystrokes. They manually credit JP Morgan's reserve balance with $1 billion.
Wait, they just type the number into the database.
They just type the number. Look back at the accounting equation. By adding $1 billion in Treasury bonds to their assets, the Fed must balance the ledger by creating $1 billion in new reserve liabilities. That newly typed liability is the newly created money. The act of purchasing the asset organically creates the capital required to fund the purchase.
If I want to buy a house, I have to check my bank account to ensure I have the capital to afford it. If I don't, the transaction fails. But the central bank operates under a completely different law of physics. They buy the asset, and the purchase itself generates the cash. It is basically the ultimate financial cheat code.
It is a defining privilege of a sovereign fiat currency issuer. However, there is a crucial structural limitation embedded in this process, a legal firewall that is vital to the stability of the system. Notice in our example, I specified that the Federal Reserve buys the Treasury bond from a commercial bank like JP Morgan. They are buying bonds in the secondary market. They do not buy the bonds directly from the United States Treasury.
Why is that distinction so important? If the ultimate asset is U.S. government debt, what difference does it make whether the Fed buys it directly from the Treasury or buys it secondhand from a commercial bank?
It makes an enormous difference regarding inflation expectations and fiscal discipline. The Federal Reserve is legally prohibited from participating in the primary market, meaning they cannot buy debt directly from the Treasury at auction. If they could, it would be a process known as direct deficit monetization. The government could pass a budget to spend $10 trillion they don't have, and the Treasury could just hand a $10 trillion bond directly to the Fed, who would instantly credit the government's account with 10 trillion newly typed dollars. Historically, direct monetization is the fastest, most reliable route to catastrophic hyperinflation. It's the mechanism that destroyed the currencies of Weimar Germany and modern Zimbabwe.
So the firewall is the open market.
Yes. The U.S. Treasury must first sell its newly issued bonds at a public auction to the private market, to domestic commercial banks, pension funds, and foreign governments. This process forces the government to face the reality of market-driven interest rates and private demand. Only after the bonds have been absorbed by the private sector can the Federal Reserve step into the secondary market and purchase them from entities like JP Morgan through quantitative easing.
But practically speaking, if the market knows the Federal Reserve is standing right behind them, ready to buy up trillions of dollars of bonds in the secondary market, aren't the banks just acting as brief intermediaries? I mean, the Fed is still ultimately absorbing the government's debt and expanding the money supply to do it. It feels like direct monetization, with just one extra step to make it look respectable.
You have just articulated the core structural critique of quantitative easing. While the legal firewall of the secondary market prevents the immediate unchecked printing of money to fund daily government operations, the macroeconomic effect over a longer horizon is remarkably similar. And again, as impartial observers of these mechanics, we have to look at both sides of the ensuing debate. Proponents of QE argue it is an essential tool to lower long-term interest rates, prevent deflationary spirals, and stabilize employment during severe crises when traditional monetary policy hits the zero lower bound.
Right. And the critics.
Critics argue that massive sustained QE permanently distorts free market price discovery, artificially inflates asset bubbles in stocks and real estate, and ultimately acts as an invisible, regressive inflation tax on the working public by systematically diluting the purchasing power of the existing currency supply. The mechanics of typing the reserves into existence remain identical. It is the interpretation of the consequences that divides economists.
Okay, so that is the mechanism of creation. The Fed buys assets, types in the reserves, and the monetary base expands. But what about the reverse? In recent years, the Fed has been fighting inflation through quantitative tightening, or QT. How exactly does a central bank destroy money? Do they hack back into JP Morgan's account and hit the delete key?
It is the exact same double-entry accounting equation, simply run in reverse. When the Federal Reserve wants to shrink its balance sheet and destroy liquidity, they don't actively confiscate reserves from commercial banks. They let the passage of time do the heavy lifting. Remember those Treasury bonds the Fed purchased during QE? Those bonds have a fixed maturity date.
Let's follow a specific bond. Let's say a $1 billion Treasury bond currently held by the Fed matures today. What happens?
When the bond matures, The U.S. Treasury legally owes the Federal Reserve $1 billion in principal. The Treasury collects that $1 billion from the public through taxation, and that cash sits in the Treasury's general account, which is held at the Federal Reserve. To settle the debt, the Treasury instructs the Fed to transfer the $1 billion from the Treasury's account to pay off the maturing bond.
Okay, so the Fed gets paid back.
But here is where the destruction occurs. During normal operations, the Fed would take that $1 billion and immediately reinvest it by buying a new bond in the secondary market, keeping the balance sheet stable. Under quantitative tightening, they simply choose not to reinvest. They accept the payment and they cancel the ledger entries. On the Fed's balance sheet, the $1 billion asset, the matured bond, is removed. Simultaneously, the $1 billion liability, the reserves they debited from the Treasury's account to settle the trade, is also removed.
Assets minus $1 billion, liabilities minus $1 billion.
Exactly. The money isn't moved to a vault. It is literally canceled out of existence. It evaporates from the closed loop. The monetary base physically shrinks. And just as quantitative easing injected liquidity that flowed outwards to inflate risk assets like stocks and real estate, quantitative tightening actively drains liquidity from the financial plumbing, increasing borrowing costs and putting structural downward pressure on asset valuations.
Wow. This mechanical reality brings us to the final and, frankly, most mind-bending segment of our research notes. Because if the Federal Reserve creates money by holding debt assets, what happens when the value of those assets fluctuates wildly? During the pandemic, the Fed engaged in trillions of dollars of QE, buying bonds when interest rates were pinned at near zero. But then inflation hit, and the Fed aggressively hiked interest rates up to around 5%. Basic bond math dictates that when interest rates go up, the value of existing lower-yielding bonds goes down. So what exactly happened to the Fed's massive portfolio of pandemic-era bonds?
They suffered catastrophic, historic losses. The Fed purchased a massive portfolio of bonds at peak valuations with microscopic yields. When they subsequently hiked rates, the open market value of those old bonds plummeted. If the Federal Reserve were forced to liquidate its portfolio at current market prices, it would recognize massive unrealized losses. The hole on the Fed's balance sheet is currently estimated to be well over $1 trillion.
Wait. If a normal, systemically important commercial bank like Silicon Valley Bank lost even a fraction of $1 trillion, it would trigger an immediate fatal bank run. They would be insolvent, the FDIC would step in over the weekend, and the bank would cease to exist. How is the Federal Reserve operating normally with $1 trillion hole in its balance sheet?
Because the Federal Reserve is not subject to the solvency constraints of a commercial entity. They possess an accounting superpower unique to sovereign central banks, known as deferred assets. It is the ultimate bureaucratic magic trick to ensure the central bank can mathematically never be declared bankrupt.
How does booking a loss as a deferred asset even make logical sense?
Normally, the Federal Reserve generates a healthy profit. They earn interest on the trillions of dollars of bonds they hold. They use a small portion of that to cover their operating expenses. And by law, they remit the remaining billions in profit directly to the U.S. Treasury. But right now, because of the rate hikes, the Fed is operating at a massive negative carry. The interest they are required to pay out to commercial banks on their reserve balances is significantly higher than the tiny interest they are earning on their old pandemic-era bond portfolio. They are bleeding cash every single day.
So they are taking massive operational losses.
Yes. But if they recorded those losses normally, it would deplete their capital buffer and technically render them insolvent. Instead, the Fed utilizes a unique accounting rule. They take these operating losses and record them as a deferred asset. They essentially write an IOU to themselves. It's a ledger entry that legally states, we acknowledge we are losing money, but we will simply halt all future profit remittances to the Treasury until we earn enough future profit to pay this specific IOU back down to zero.
That is staggering. They lose $1 trillion, and they balance the books by writing a note that says, I owe myself $1 trillion, placing it in the asset column and moving on with their day. And because they are the monopoly issuer of the currency, no regulator can call their bluff. As long as the global public continues to accept the U.S. dollar as a medium of exchange, the accounting illusion holds firm.
It is the ultimate privilege of fiat sovereignty. But understanding this deferred asset trick leads us directly to the foundational anchor of the entire global financial system. Where does the intrinsic value actually originate? A century ago, the dollar was a derivative of physical gold. You could walk into a bank and exchange a paper note for a defined weight of precious metal. The system was tethered to a physical commodity.
But the gold standard is long dead. Today, under the modern fiat regime, what is the primary asset underpinning the Federal Reserve's balance sheet?
The overwhelming majority of the assets backing the U.S. dollar are United States Treasury securities. The U.S. dollar is backed by U.S. government debt, and what fundamentally is a Treasury bond. It is a legally binding promise by the United States government to extract future productivity from the American public via taxation to pay back the principal and the interest.
So the physical $20 bill in my wallet is ultimately backed by the future tax liabilities of myself and my neighbors.
In the purest macroeconomic sense, yes. The entire architecture of the dollar is anchored by the taxing authority and the future economic output of the United States. And this structural reality leads us to the ultimate provocative paradox of modern finance.
Lay the paradox on me.
In the political sphere, the national debt is universally decried as a crushing burden. Politicians constantly campaign on the promise of balancing the budget, eliminating the deficit, and eventually paying off the national debt entirely to free future generations. But let's run a mechanical thought experiment based on the accounting rules we've just outlined. Imagine that tomorrow, the U.S. government discovers an unprecedented source of revenue, or taxes the economy at 100%, and miraculously manages to pay off 100% of the national debt. Every single Treasury bond in existence is redeemed, paid out, and permanently retired. What happens to the U.S. dollar?
Let me trace the accounting. If the national debt is eliminated, there are no more Treasury bonds. If there are no more Treasury bonds, the primary asset on the Federal Reserve's balance sheet drops to zero.
And according to the iron law of double-entry bookkeeping, if the central bank's assets drop to zero, their liabilities must also drop to zero to balance the ledger.
But the Fed's liabilities, the liabilities of the money, the commercial bank reserves, the physical M0 cash, they're all liabilities of the Fed.
Exactly. If the United States government were to magically pay off all of its sovereign debt, the primary assets backing the currency would vanish. Under the rigid mechanics of our current central banking system, the U.S. dollar would have to be mathematically extinguished. Global liquidity would be instantly eradicated. The commercial banking system, which relies on treasuries as base collateral, would implode into a deflationary black hole.
That completely inverts everything we're taught about basic finance. To have money, we must have debt. The existence of the currency requires the existence of the liability. Debt isn't a burden on the system. Debt is the system.
That is the inescapable reality of a credit-based fiat monetary framework. Sovereign debt and systemic money are simply two sides of the exact same accounting coin. You cannot eliminate one without destroying the other.
Wow. I want to try to synthesize this incredible journey we've just been on, because we've covered a staggering amount of ground. We started by mapping the water source, the basic tiers of high-powered money, M1 checking and M2 savings. We explored how those definitions became blurred by the regulatory shifts of 2020, and how massive pools of purchasing power are currently hiding out in the shadow banking system of Treasury ETFs and disintermediated collateral.
Right.
We examined how corporate giants navigate this plumbing, how Google acts as a wholesale shadow lender, while McDonald's performs brilliant, highly leveraged WACC optimization, utilizing negative equity and tax shields to maximize shareholder returns. We used the 2008 crisis to see how pristine cash flow acts as the ultimate safe haven when maturity mismatches destroy companies like GE and Lehman. We pulled back the curtain on options theory, using the Merton model to understand exactly why distressed meme stocks pump violently in response to central bank rate cuts. And finally, we dissected the keystroke accounting of the Federal Reserve, revealing that money creation is just ledger manipulation, that trillion-dollar losses are hidden with bureaucratic IOUs, and that the very existence of the global reserve currency relies entirely on the perpetual existence of sovereign debt.
It really is a framework that fundamentally alters how you interpret financial reality.
It truly does. And for you listening, whether you are managing a personal retirement portfolio, trying to figure out the optimal time to exercise your tech industry stock options, or simply trying to decipher the underlying truth behind a chaotic financial news headline. Viewing the economy not as a static pile of physical cash, but as a massive, constantly shifting ecosystem of ledgers, credit facilities, and rate limiters changes your entire perspective. You realize that an interest rate cut isn't just about cheaper mortgages. It is a vital lifeline that violently alters the survival probability of highly leveraged corporations. You realize that corporate balance sheets aren't just records of past performance, they are highly optimized, forward-looking chessboards designed to exploit tax codes and credit spreads.
True financial literacy isn't just knowing the definitions of the metrics, It's understanding the hidden mechanisms that drive those metrics and recognizing when the traditional rules no longer apply.
Precisely. But before we wrap up, I want to leave you with one final, unresolved puzzle to mull over. We've just spent an hour definitively establishing that modern, flexible money absolutely requires sovereign debt to exist. Government debt is the indispensable anchor of the fiat system. But as we look toward the horizon of financial technology, what happens if a decentralized, stateless asset like Bitcoin or another truly digital currency actually succeeds in becoming a widely adopted global reserve asset? How exactly does a future financial system create the massive, elastic credit required to fund global industry without a central bank holding sovereign debt as the foundational anchor? How do you maintain a stable 30-year mortgage market without a central bank manipulating the yield curve through quantitative easing?
That paradox is arguably the multi-trillion-dollar question that will define the next evolution of global finance.
It absolutely is. It forces you to look at the entire structure and wonder what happens when the foundation changes. Thank you for joining us on this deep dive into the financial plumbing. Keep questioning the consensus, keep looking past the headlines, the underlying ledgers, and keep tracking the flow of the capital.